go into the call, which also works, it seems. And now let me quickly share this. Just gonna give me a hard time, I think. Oh, it's not. Nice. And now, where are my settings? Okay. Has a signal. Has a good signal. Oh, yeah. It's good. They will hear it. Perfect. They should all come out. Yeah, they do. Perfect. This one is much louder. This one is not. Oh, just give me 1 second. Just to adjust these. This is this one. And this is this one. Check, check. Check, check. Oh, okay. Good.
Hello. Hello. तिमी पनि अनलाइन रहेछ है?
Sorry, nominated recipe of who I audio connected to.
Hello. Richa,
हजुर.
can you hear me?
Yes, yes.
I admitted Georgios, but I can't
Hi.
hear him.
I'm just
Yeah.
connected.
Hi.
He's connected now.
Okay.
Yeah, sorry,
Yeah,
it just took a little bit of
hi.
time to connect.
I'm not sure if I'm visible.
I can see you now.
This way, but okay, great. So we can hear you and also see you, so it's good. I think probably you can also see yourself a bit on the screen, but
Yes,
we will make it
I
big.
can. No problem.
Yeah. So I think you will
Okay.
be able to see the panelist and the moderator, and then you will be up on the screen. So yeah, sounds good. We can hear you well. Can you hear us well?
Yes, I can hear you very well. The camera is looking at some of the seats, of course, so maybe we can tilt it a bit. Yeah, exactly. Hello.
Yeah, because the camera is for the panelists, and it's gonna move.
Okay.
We
So
can
it's no
actually
problem
move
then.
the camera. So someone who's gonna be here, they will be controlling it with the remote control, you know, that it faces whoever speaker is speaking.
Perfect.
But we can see you and hear you.
Yeah, that's the most important, I guess. What would you like me to do? Would you like me to turn off the camera and keep connected? Should I dial off and dial in a little bit later? What would you like me to do?
I think since there's a lot of time, maybe it's better to dial off later. I mean, it's up to you totally. You know, you could also just put off your camera and, you know, mute yourself and do your work. But we are going to have around, I mean, it's more than an hour left to just even start the event.
Yeah, exactly. It's at 6 o'clock, right?
Yeah, it starts at 6. You are in the first panel, so
I'm in the first one. Yeah,
it's totally up to you. Yeah, it's totally up to you.
No, I will hang up. Then. What time would you like me to dial in? 10 minutes before 6 or 5 minutes before?
Yeah, that would be great.
I mean,
Sebastian, will you be here handling, or should someone from? Okay. So I'm just going to ask someone to be here.
Yeah, I'm going to dial back 10 minutes before, but then you just need to admit me because just now I was in a waiting room. So just tell whoever's going to be here to. Okay. And then when you add me, I'm going to keep my camera off, right? No, don't worry. I'm going to keep my camera off so that you can wait until the panel starts, right?
Yeah.
Okay. And then after my panel, I can obviously turn off, right? There's going to be a new panel. I'm going to just disconnect. Yeah?
Yeah. That would be great.
Okay. Perfect. Okay. So I'll speak to you in 40 minutes. Okay.
Sure. Thank you so much.
Thank you. Bye.
Bye.
I didn't know you were here. Why are you
not about to come? I was not about to come because last week, I don't even remember when, me and the baby, we fell off the stairs together. Yeah.
The caterer just told me that they have no one here to handle the food, right? So
Yeah.
I guess we have to do that.
Yeah.
Okay.
Usually it's very easy for them. It
Yeah.
comes in a cold, it just
Yeah.
comes in the tray.
Okay.
I'm used to it. We have a team who could, two of them are there to help you out.
Okay, good. Because we're just two of us, you know, we have to send the drinks, the technique, and it's like.
We have the team there.
Okay.
One more guy is coming, so we have enough people.
And how is the baby?
Luckily, the baby had just a bit bruises, but you could imagine I was like, because you know, the living room is upstairs, and then she was sleepy, so I wanted to put her down in her bed. And then we were just walking, and then, you know, these days she's very strong. She moves.
I know. They
and
do
then
this.
It startled me, and then
you lose
slipped.
probably lose the balance, and you can't.
Yeah, exactly. And then we
same.
both felt really bad, and I hurt my toe really bad, so I can literally not walk, drive, nothing. I came taxi, and I will go back. I just came because Mark could not manage to come during lunch earlier.
But I told you I was coming here at 5. I mean,
yeah, but you know, the technical setup had to do.
no, I don't know how to do it anyway.
Yeah, so I just came.
Like me and technical things, even when I had to take a phone call, I struggle. Like me and technical, like 2 different worlds.
Finance, great.
Are we gonna use this, or do we have that?
I think all of them have.
Because I don't remember my speech. I need to read it.
Okay.
So
I'll be right back, yeah?
Are we going to have
so for me,
just this?
Yes.
Okay. Okay, sure.
sorry, do you have a microphone like this?
We do, but with your panel, you have to switch them and then we get difficulties.
No, but for me, I'm doing a solo speech. I can't do this and like, you know, turn this around. I just need one. Mine is gonna be like, I'm gonna be at the beginning. It's gonna be a 2-minute speech.
Absolutely. Okay, I'll arrange.
Thank you so much.
I'll be right back. Yeah, then we got you.
Thank
Okay.
you. Yeah, because of the voice.
Yeah, okay.
I can't
I get
manage
it.
to do this. There
Yeah.
it is. And I can't read. I wish I see that there is not too much light on my face because I have too many people close to me here. Too many should be here.
Let me go a bit back.
Yeah.
and tell you. The camera is also there. Just be mindful to sometimes look that side
Yes. Yeah.
for people who
Yes.
are online, but you know, the main audience is.
Yeah.
I wouldn't stay here because of the lights.
Yeah.
Yeah.
So I will
perfect.
stay here in front of
The
this.
light is really good, like a good kind of light.
Okay.
No, yeah.
So I will sit here. Oh, I should have brought with me like the tape, but it doesn't matter. Like to tape the floor.
Just in front of this chair is okay.
Yeah,
This chair is always going to be there.
Yeah,
so
exactly.
You can just
Okay.
sit on the
So
floor.
this looks good.
Yeah.
And I don't have a bad light on my
No,
face. Okay,
No,
good.
Because
Thank you.
here from the presentation, I never liked it.
Thank you.
Here is a good
And
light.
Mark has been so kind to let me do like a 2-minute speech. Because I'm looking for a job. It's so difficult.
I find it someone. So.
Oh, how did you do it? Tell me. But what is your background? No, but also what's your background? What's your background? IT.
So I did project management.
Yeah, you're very easy to place. Yeah. That's
Yeah,
good.
For
That's
me,
good
it
for
was,
you.
you know, it was for me, just, I had to search. First, I was like, what type of job am I going to search?
Yeah,
But then I did not find anything below 100%. I wanted to work maybe 60% or 80%.
So you're gonna be 100% again.
100%. So maybe 2 days Mark works home office, so we have a nanny for 2
Yeah.
days, and then 3 days I take her with me and put her in the kita next to my office, that just in case something happens.
Okay.
Yeah, I have also some nannies in hand, just in case I cannot.
Oh, totally.
Sometimes when she calls for sick and you have to emergency go, and I have a meeting in a new job, I won't be able to do
It's
it.
difficult, and then let's be frank, they're women, so they always think, oh, she's not gonna go because the daughter and son.
No, Mark volunteered. He said, like, if it's too much for you, I'm gonna take her to the Kita Ibadu's. And I said, she makes money when she's sick, or, you know. And also me, I think it could be right now. If she sleeps for 2-3 hours more, I'm like, I miss her. Oh, I can't do that.
I have a big change. I was like, now you go when put her to sleep. Then back to if I do it, then I check if she's still alive. I still, like, before I used to check that all the time, like now I don't check all the time.
Like when she sleeps for a bit longer, I'm like,
Yeah, yes.
and I think I was nuts, but okay.
Yeah, no, everybody has.
Do you want some coffee or
No,
water?
thank you so much. I wrote this yesterday. And again, I'm happy to do the class, but not in the investment one, because I need to do a job. I do the communications. I do this because already, I used to be very senior. It is just this, but yeah. Everybody know him. George or something. Like it's a small role, what he does, like, and then I moved here, because my husband moved here, and I was not in charge. So, and so basically, that's when I realized that what I do about was doing some piece about it.
Yeah. And just, you are a technical guy. I don't have to say how you need to. So this is the laptop.
Yes.
Here is, I think here are the presentations. These are the presentations.
Okay, so they are there already.
Yeah, they're already
And
there.
the
You
first,
just need
the
to.
first guy, 1805. Which is his presentation?
He's in a panel. So we
Oh, okay.
have the background running slide.
Okay.
That's just gonna be there. And then when the panel comes, you just have to put this one on, that it's on the backstage. And then we have one speaker, Matthias, and then them. So whenever the thing progresses, the background is going to be this slide. So it's called background running slide.
Okay.
Do you have a slide with me at the beginning to introduce
With
myself?
you? No.
I can make it for you if you want now.
It's just that this is PDF.
Okay, so we're not gonna do
We
this.
will have to.
So why don't we do this? When I'm speaking, we're gonna do
Just
just
this,
this
yeah.
one, just this one.
He will
So
do it.
I will be so Mark Ado is coming here, right?
Yeah.
So he will do the opening. Then I'm gonna be he will do the introduction to Summer. I will be the opening of the conference. When Mark is speaking, I think he's gonna go.
He
with
has
the-
a slide.
yeah.
No, he has a slide.
He has
Oh
the
shit, it is
usual, like,
Apple.
video probably.
Samba video, yeah.
Yeah.
So when I'm speaking, if you just put the cover one, right?
Which is the cover one? Show me.
This
which is the
one.
cover Okay.
Investor
this
Leader
one.
All right,
Summit.
all right.
Just
Yeah.
because after that there will be already like, can you scroll up? Sorry.
Oh.
I think
Where
after
is
that there will
it?
be only the speakers already. Yeah, if you
Yeah.
scroll up. Yeah,
This is
then
already
he's
a
already
panel.
after me. Okay.
Yeah.
So you should open this one when the moderator is coming to the stage, not before. So just let them first go there and then you change the slide if it's okay.
Sure,
please.
sure.
So when I'm speaking, just this
So
one.
once all the speakers are here, then I show that slide. Or as they're coming in, I show
No,
that
I
slide.
think when he arrives, the moderator,
Because there's 5
Yeah.
of them.
when he
Yeah.
arrives,
You can already change
he
the
can
slide.
put, and then they will sit down. So people are already familiarized with name and thing.
Okay.
So, yeah, but when I'm here, yes, I'm not gonna cover. I think if I'm standing here,
There's only 4 seats for 5
yeah, and I'm
moderators.
sitting here.
Yeah,
Okay.
I think the moderator is just gonna walk and
Yeah.
then
Okay.
4 speakers. This is how it was
Alright.
done.
Okay.
And it's just that.
Okay. Only Mark's intros slide.
There is a slide. There is a slide.
Yes, maybe have that open, and I know that's the first one, and the rest we can close the other windows.
That's
Which
why
are-
there's too many windows open.
Exactly, because that's not on the PC, and then of course there's sometimes you open the wrong window and it's messy.
I just cannot find it, and I'm not good with MacBooks.
Okay, then hopefully Mark arrives in time.
I think we could. I don't know where
It's
he has
normally a
saved.
PPT or a video.
It's a PPT, Google Chrome running investment leader PDF. Where is a folder? These are all I might have mistakenly closed something. So no, I
Maybe
did not
open
close it.
PowerPoint and let's see if the latest.
No, this is not ours. This
Okay.
is not our laptop as well. This is Trust Square's laptop.
I see.
We
Okay.
just need Google Chrome.
Is it on Google Drive?
Yeah, it's Google Drive.
I see.
So let me just open mine.
Okay.
Yeah, here we are. Yeah, here you go. So
Have you opened it?
so background.
Oh, is this just the Google Drive folder?
Yeah, Investors Leader Summit Marc-André.
It's the flyer.
This is the flyer. I don't know
What's the
why.
name of the event? Samba?
Investment Leader Summit. Something is. So this is Mark's slide. Huh?
Oh, okay. It's also a PDF.
Yes, everything is a PDF.
So no video this time. Because normally his
Yeah.
intro slide comes with this summer video.
Yeah, it comes. Huh? So you have to click.
Okay. So there's a slide. You have to click and then it opens
Mhm.
a browser window.
Yeah,
Okay. Okay.
yeah.
Okay. Got it. Okay. Got it.
So you need to be careful that it is coming, huh? Because usually I also have problems. Sometimes the window is opening here, but not there. So but I mean, it's easy. You just know it now. So
You closed it.
yeah, I closed it.
Keep it open. I mean the relevant files. I would keep them open,
All of them.
and the others I would close.
There are many relevant files here. Would you not be okay if I just open this folder and because
Okay.
this
let me
is
have a
a
look.
background. Yeah, this
Let
is
me
the
have a look.
background.
Yes. The first one is the
And
background.
here we have Mark.
Yeah,
So it's
okay.
Mark's
Okay.
one. And this is of someone else. I think it's Matthias. No, this is of the speaker. Meet team.
Okay, so we see this window. How do we go into full screen? How do we go into full screen on this laptop? Do we need to maximize this window? Or is there somewhere you
I
can
just
say?
know the Windows version of it. I've never used Mac. I mean, maybe Mark can. Mark is going to. He should be here.
No worries, Amiga. It's okay.
Here.
I asked you because I thought you may know.
No.
Okay, the rest we can figure it out. So is this the one that says full screen or no? Share, what does it say? No.
So you are also a Windows user.
Also a Windows user.
Yeah.
Those who are smart and don't want problems use Windows. And those who are thinking they are smart, but
okay.
don't mind dealing with the
Let me quickly
problems.
check with Mark where he is. Because he should be.
This is full screen. This is full screen.
There is a guy that is coming around in like a few minutes to actually help with that because it's not our laptop. That's the problem. Where?
Just a moment. I give you Maran. Mark. He needs help.
Ciao, Mark Andre. Hey, no worries. Okay.
Mega.
Yeah. So, one second, Mark.
Can we
Yeah.
the user
Okay.
user restrictions on e-train ma? It's okay to turn
Uh,
that into yes.
Okay, yes.
Okay. So now the streaming is also working.
Okay, good.
Yeah, you can check also.
Just in case there is some problem, we can always email everyone with the Zoom link. है केही टेक्निकल प्रब्लम भयो भने सिधै जुम लिङ्कमा पठाइदिए भयो नभए त्यो युट्युबको लिङ्कमा पठाइदिए भयो
युट्युब लिङ्क हुन्छ
मैले अघि पठाएको किनभने जुममा आएर फेरि सबजनाले हल्ला गर्न सक्छ हैन है ल यहाँ मान्छेहरू आइरहेछ सो म जान्छु है
ल ओके
Mute, yeah. Okay. Then wait. Here the video. So okay. Okay. That's not working. Why is it not? So there. Oops. Yeah.
Ja, schau. Hast du uns irgendwelche Sitze reserviert?
Ladies and gentlemen, I would like to start. Welcome you all. 1 second. Yeah. Thank you. You cannot make it louder. Okay. Okay. So welcome everyone. So we have heard or not heard or at least seen the video. Sorry, it was a bit not so loud, but I think you have maybe seen it already in other events. So I'm Marc André, the president of the Swiss Association of MBAs. We do events like this. We focus on topics like digitalization, sustainability, investment, and of course D&I, career. And career, I think in general is the main topic in that overall. So we want to help you grow your career. Can be in finance, in other areas. And if you move to the next slide or 2 slides, I think. So you see all these, our partners, we collaborate with these universities and also with these company partners. So today we would like to thank Bank Schroders for the great collaboration. Thanks Giovanni, of course, you have been already several times a great speaker in our investment roundtables we do every month, as many of you know. Then on the next slide, you see the great team of the investment roundtable. You see Gabriela and Marcus is unfortunately not there. He's in China, but Gabriela is here. And here we have Silvia also from the team, and Thomas will be moderator, Thomas Wille, and many more. And on the next slide, you see upcoming events. So we do on an annual basis this investment leaders roundtable, and then we have a new event next year. As I mentioned, career is a big topic, so it was not so much on the table so far, and we would like to change that. So therefore, we created the HR and Talent Leaders Summit next year. And then the digital leaders, also our annual event, and then the chief marketing officer and the sustainable leaders we have done just 2 weeks ago with Dana. She's there from the Sustainability Council. Where is she? Is yeah, there. Thank you. And yeah, we would like to show you a quick update that you could use. So we have created like a Google Calendar that you can subscribe all our events. So then you get every event in your calendar. So I will send all of you an email so that you can follow. And that makes it easier that you have it in your calendar. Of course, you don't have to come, but yeah, it's easier to remind. Then on the next slide, here you see how it works. So a quick guideline, and on the next slide, now you can see the benefits of being a premium member. You can attend our events free of charge, and you can network, and also the people online are using now our 3D event space eTrain. Then we have the professional expert call. So a new feature is coming next month, so that everyone who would like to be an expert can provide these services free of charge, and then you can book a meeting. For example, I'm a lawyer, so if you have a legal question, so you can book a 30 minutes call while I'm driving from Liechtenstein to Luzern. So yeah, if you want, it's free of charge. It's not, yeah, it's just one of the services. And then we have HR expert. If you have a career coaching questions, so they are offering their services also free of charge. And on the next slide, yeah, a very important one. So please scan this code and fill out. So I will wait for 1 minute that everyone fills out the survey. Last time on the Sustainable Leaders, only 3 people did the survey. So I really, I really beg you, please fill out the survey and give us feedback, even if it's bad. So any feedback is welcome. So if possible, good, but if not, then please let us know. So can also say, we want to change this president, he's annoying, but whatever you would like. So yeah, you are very open. Also, topic is very important, that we want to know, like what is in your interest, so that we cover it. One is for the investment, but also for other related topics. For example, the HR team, the council would like to know, like, yeah, what topics are important for you, that they write articles and blogs, and yeah, for them it's important that they write articles that are important to you. So I keep waiting, please fill out. Yeah. So 3, 2, 1. So I think we continue. So I hope, yeah, please fill out still. But I hand over already to Silvia. We have Silvia here as a host. She's part of the investment roundtable. And for those, but this is not so important, but if you want, please join also our WhatsApp community. But now I would like to start with the conference and hand over to Silvia. Thank you very much for your time and hope you like it.
Hello, everyone. Can you hear me well? Perfect. So, ladies and gentlemen, esteemed colleagues and honorable guests, welcome to the 2024 Investment Leader Summit. It's great to be here again this year. Last year was a great success for those who were here. And in fact, I see so many very familiar faces. For those who don't know me yet, my name is Silvia Savini-Elborg. I'm the principal of Sunstone Impact Advisory, and I sit also in the Samba Investment Committee. I have an MBA from Columbia Business School and one from London Business School, as we are here part of the Swiss MBA Association. As we gather here today, we find ourselves at a pivotal moment in history, where the landscape of global investments is being reshaped by a confluence of unprecedented challenges and extraordinary opportunities. In an era defined by rapid change and increasing complexity, our world stands at the intersection of transformative forces that are redefining the very nature of risk and reward. From this existential threat of climate change to the revolutionary potential of artificial intelligence, we are navigating a terrain that demands not just our attention, but our innovation and adaptability. Consider, if you will, the dual nature of our current reality. So on one hand, we face this
sobering prospect of extreme weather events reshaping our planet, while on the other, we witness the dawn of AI-powered technologies that promise to revolutionize industries and societies alike. The global stage upon which we operate is marked by increasingly polarization and geopolitical tension, challenging us to maintain stability in our investments while seeking opportunities in the emerging markets. Economic headwinds from inflationary pressures to recession fears test our strategies and resolve. Yet, amidst challenges, we see unprecedented potential for growth, innovation, and positive change. As the leader in the investment community, we are called upon to do more than simply react to those forces. We must anticipate, adapt, and act with foresight and purpose. The skills that will define successful leadership in this new era go beyond traditional financial acumen. They now encompass adaptive decision-making, cross-cultural competence, and the ability to build and lead high-performing teams in an increasingly diverse digital world. Over the course of this summit, we will develop deep into these interconnected challenges and opportunities. We will engage in a dialogue about the future we want to create. How can we as stewardship leaders can control a more sustainable, equitable, and prosperous world? How can we harness the power of investment to drive positive change in the face of climate crisis, societal division, and technological disruption? As we embark in those discussions, I challenge each of you to think boldly, to ask questions, to imagine new possibilities. The future of investment is not just managing risk, but is about creating value in a world of constant change. Thank you for joining us in this critical juncture. Let us make the most of this opportunity today to learn, to connect, and to chart a course toward the future where investment serves not just as a means of wealth creation, but as a powerful force for global progress and prosperity. And with that, I declare the summit open, and I am welcoming to the stage Thomas Willy.
Also, a warm welcome from my side. I don't want to waste too much time introducing myself. My name is Thomas Willy. I'm the CIO of Copernicus Wealth Management. Normally, I'm sitting here in the round table, but tonight I'm the moderator, and I can challenge my colleagues a little bit. On the one side, on the, let's call it on MS Teams, we have George Leontaris. He's the CIO of HSBC. Then I want to welcome Dr. Anja Hochberg. She's head multi-asset solutions at ZKB. Then a good colleague of mine, Dan Scott, CIO of Vontobel, and last but not least, Giovanni Leonardo. He is head of investment management of Schroders Bank. Please come to the stage. In the middle. I don't know.
It is on? Yeah, it is.
Is it on? Good.
It is.
Good. Absolutely. So, George, you can hear us?
Yes, I can. Hi, Thomas. Hello, everyone.
Oh, hello. Good. It's an Outlook 2025 for the CIOs here in Zurich, but still, I mean, those who know me, I still want to look a little bit back. So what worked in 2024? And so what was the highlight and what was the low light? Let's go with lady first.
My highlight, my low light.
Yes.
Well, we have above average returns. I think that's certainly qualifies as an highlight. The low light, as some of I prefer more balanced portfolios. So what we have seen in terms of return contribution has not been particularly balanced, at least not to the degree we like it. We hope and we are quite sure that this is going to change. So it's not going to be all about NVIDIA in the future.
What about you, George?
Yes, I think a lot of things worked this year in the sense that we were fully invested. So zero cash, overweight equities. Some of the high-level calls on the dollar, for instance, worked. Some things that didn't work so well, for instance, the gold rally. That's something that we were neutral, so we didn't participate in all of the strength. We did have a slightly more risk-on positioning on the equity side, which meant we were a little bit more prudent on fixed income. So our relative preference for investment grade versus high yield didn't work as well as anticipated. But net, no complaints. I think most of the calls worked and performance has been pretty good.
I'm hoping that nobody's complaining when I'm looking at the market. Dan, what about you?
So I'd say being underweight high yields didn't work. Being overweight government debt didn't work. In terms of absolute return contribution was okay, but relatively not so great. What did work was overweight equities, and what did work was overweight gold. So going back to a risk-on stance now, I think the way we started the year is the way we need to be positioned. And like you say, and like the rest of the panelists were saying, net, it's a pretty good year, regardless of how you were positioned, because pretty much everything was up. And so, if even a balanced portfolio in dollars bring you 10%, it's a bit of an ointment after 2022, when most of us multi-asset investors were maybe questioning ourselves.
What about you, Tony?
Yeah, I think it was a very good year, also for Swiss franc investors, which was a big surprise. Equities, the place to be. We had preference for the US. I think historically the US is really outperforming. If you look at the MSCI World ex-US, it has a bit a different trend. Just do that once for yourself. You can ask an AI to do that and plot the chart. On the alternative side, gold was a very good place. What didn't work out was the materials call. We had one materials call. This is not yet developing in the right direction, but overall a very good year. And I think on the bond side, you might remember last year, I said it's maybe time to add a bit of government bonds and to start to add duration. And I think that's the way to balance the risks in your portfolios.
I mean, now we are warm, isn't it? Now we are ready for 2025. So, I mean, I give you the word right away. So, I mean, let's go to macro. I mean, before we go to all the other geopolitics and AI and US exceptionalism and all that stuff, macro-wise, how do you see 2025? Are we still in a okayish environment, or do you already see some divergences between Europe, US, and probably EM, including China?
Me?
Yes. So the other three can now prepare mentally.
So I mean, for us, I think growth is extremely strong. The economies are pretty strong and resilient, actually. All these interest rates increases we have seen historically, usually you would have seen a strong recession. This was not the case at all. And actually the US is really developing in the right direction. Therefore, from a global growth perspective, this looks okay. The problem is a little bit in Europe, which includes then Switzerland, because there we have, and usually everyone tends to say, it's driven by Trump or by whoever, but actually the problems in Europe, they are self-made. They are regulating a lot, whereas if you listen to Trump, it's exactly the different thing. They will deregulate. And therefore, in Europe, growth is kind of, they're already in a recession, in my opinion. Especially Germany, it's the biggest problem. And if Germany has a problem, it has an impact on us here in Switzerland. So I'm a bit concerned about that. China, I'm personally a bit more optimistic than my economists. I usually think when everybody sees, you know, that everything is going on the wrong direction, maybe it's the right time, but never touch a falling knife. So we rather wait there. I think from China, the action taken are not really helping at the moment. They have to do real lot more. And we don't know what's going to happen with this US-China situation. I personally think that Trump is going to go in the direction of, you know, we are all fear tariffs or whatever, but actually what he's going to do is he just wants to make the US more attractive. And therefore, from a growth perspective, I think you still need the US despite valuations.
You have the same picture on you?
Well, at least I try to be somewhat controversial here. Let's start with the fact that, you know, it's an attempt. Let's see, you know, whether it's work. You know, in my opinion, for a tactical view or a semi-strategic one for next year, I'm not particularly sure whether growth is the only thing on macro you should look at. I mean, there are other aspects which you have to look at, but let's warm up with the macro side of things because that's how we usually tend to do it. I agree on the German issue. Nevertheless, you know, if you take the DAX as an example, Germany is doing very, very lousy in economic terms. The DAX still has been up roughly 10% this year, given the international nature. But what concerns me really on the German side is that yes, all of their problems are, you know, homemade. Even the problem with China is homemade, given the loss in competitiveness. Unit labor costs in Germany have increased by 60% over the last 20 years. That's well, astonishing, ridiculous, whatever you would like to call it. At least nothing really has happened or has happened in terms of competitiveness for the last 20 years. So we don't speak about the lost decade. It's a lost at least 20 years. On top of it, it's not just the industry. I mean, we also have a consumption side. While in the US, as we know, after Corona, people have gone back to their usual consumption pattern. In Germany, the contrary is the case. The savings quota is increasing again, and the longer they wait for any kind of government, if they at all get one in February, which I'm skeptical about as well, the longer you will have this kind of very, very sluggish economy. And yes, and it might translate, especially when we speak about, you know, the automotive industry, it could translate also into Switzerland. Also, the big difference is due to migration, and we speak about 50,000 people also this year and also the next year that will support the consumption in Switzerland. And maybe the good thing is, you know, there were the worse the situation in Germany gets in terms of, you know, economic growth, the more people, you know, from Germany, like me 20 years ago, they will join Switzerland, and that's good for private consumption. On the US side, yes, we do see a bit of moderation in terms of economic growth in our kind of main scenario. Maybe we have more than kind of 1.7 to 1.9% in terms of real GDP growth, but that should be enough to keep the economy on track. And what
in the US?
In the US, yes, and that's, you know, what we you know what we like. It's, you know, we don't really mind this kind of small deceleration of the economy as it provides and hopefully better balance, you know, also to inflation, which we consider to be a somewhat bigger risk given, you know, the Trump the tariffs and all of that. So I'm not so much worried about growth in the first instance. I'm much more worried about inflation, which is unusual for an economist. You first worry about growth and then you worry about inflation. But it's not the economy, it's the inflation stupid, I would say, this year.
So then you think that 1.7, 1.9 is a little bit low to the US?
I do. I think that's a bit conservative.
Well, we are ZKB.
But if you say it's conservative, so that means Jay can stay on the sidelines, or do you think that the Fed will still cut rates in 2025? I think 3 or 4 cuts are expected.
Well, so Christina in her opening talked about dispersion. And I think that's what we're headed for now. And I think, like you said, Anya, macro doesn't necessarily equal asset prices. You can have a bearish view on the Eurozone, but Eurozone assets, you know, German assets looking very appealing at current valuations, where you can buy stuff at discount to book. In my past 25 years in this industry, haven't had often the chance to buy stuff at a discount to book. If I try and zoom out and look at the macro, what are the most important things right now for positioning? It's the world's largest economy is stimulating, the US. The world's second largest economy, stimulating. On top of that fiscal stimulus, you have deregulation, you have central banks cutting interest rates, you have about 8 trillion sitting in money market funds, so a lot of dry powder ready to come to markets. You also have the massive amount of capex that has been spent by the Mag 7 on AI. I can't remember who it was. Maybe you guys can help me. There was a sell-side house, Morgan Stanley, I don't know, who did the work on this and tried to inflation adjust exactly the force of capex being spent on AI. And they were working out that it's equal to the Apollo space program in the 1960s. That's the amount of capex that's being unleashed. And the Apollo space program is what led to the creation of Silicon Valley. There's lots of talk about American exceptionalism and all this innovation in California, but let's be honest, it was all military spend that gave birth to Silicon Valley. And this military spend also in Europe is going to be something that is, an economic driver. So short term, I'm looking at my portfolios and I'm thinking there's just no other option than to be risk on. More longer term, it gets a bit scary because we have debt that's out of control in developed markets. And so this fiscal profligacy that if you're the UK, Liz Truss, you understand doesn't work long term. Other economies can get more away with it, but these are topics to be worried about. And also in the US, keep in mind that you have the Russell, 45% of which are not making a profit, and in 2025 face a maturity wall. They're going to need to refinance. And if rates don't come down as fast as we expect them to, you're going to have a spike in insolvencies. So while, again, the zoomed out view is very bullish, there's plenty to be worried about.
Okay. George, so we hear here a lot of growth upside, spending. Should we be worried about an uptick in inflation? Or is that just a risk?
Well, no, I mean, definitely it is a risk. What we've seen in terms of the data is that there's been a little bit of slowing in the degree of deceleration, right? So we had the last year or so where the clear trend of inflation continued up until around the summer. Since then, we've started to seeing a little bit more stubbornness in the recent prints. Now, you can look at it in many ways. You can still see a sizable chunk, roughly 45% of the composition of the basket, which is still a flattish price growth or even outright deflation, with the usual suspects, motor vehicle insurance and so on, shelter still being sticky and just being so elevated, both in terms of rate of growth, but also in terms of contribution to the basket. That means that inflation is not falling down as quickly. I think if things were to continue as they are, you're still looking for a fair degree of confidence that we're heading in the right direction. That is the terminology that most central bankers are using. But I think the real risk is the external factors. Predominantly tariffs, of course. You also have to factor in looser fiscal policy, immigration as well, to the degree that it would be impacted, and what deportations, for instance, in an adverse scenario would mean for a shrinking of the labor force, and also higher costs that would need to be passed on. So I think it's really about the tail risks at this point in time, and we've seen that in market pricing. You can see 2-year inflation swaps, for instance, that have risen 65 basis points over the last 30 trading sessions or so. You've seen yields increase. The market is now prepared for fewer cuts, still prepared for cuts, as I think you mentioned yourself, Thomas, earlier on. So I think right now the market and us, kind of expecting that the full imposition of tariffs, if you were to take a 20% universal tariff, if you were to crack down extremely hard on China, but also see tit-for-tat retaliation. So it's not just what the US does, it's how other countries will respond. So I do think that if you were to see that worst case scenario, you're definitely bracing for an inflation shock. But clearly that works for no one. And our perception is that the discussion point that we should see it as a discussion point, right? Essentially, Trump is positioning himself as a businessman. He's surrounded by people within his future administration that will understand that the imposition of tariffs is actually counterintuitive for the US consumer as well. There's real repercussions domestically. So as long as you're starting with that as a base for your negotiation in order to extract concessions and get what we would call, the smart tariffs rather than the universal tariffs, bilateral agreements, then potentially the impact on inflation can be a little bit less pronounced than what is being feared in the press. But I think we should be braced for a slower decline in inflation. That certainly raises the risk that the Fed may choose to pause. We're still of the view that we should expect a cut in December. But I think in 2025, once the new administration is there, once they start making some announcements, I think the risk of a pause, but not an end to the cutting cycle, is probably higher than what we were pricing in earlier this year.
So from a cross assets point of view, I mean, when I come to you tomorrow and we start into 2025, so is it bonds over equities, equities over bonds? Which regions? Where would you put your next incremental dollar to work?
Yeah, so we're still U.S. Preference over fixed income, right? I think fixed income, all-in yields are still decent from a historical perspective, and there's still some premium in rates, but corporate spreads are certainly at the tighter end of multi-year levels, right? So we're not too aggressive on the fixed income side. We're mindful of inflation risks and some potential rate volatility. So we have that preference for equities, given that the macro data is good. Earnings are strong. Expectations for the next couple of quarters earnings season have also come down despite the resilience in third quarter earnings, the positive earnings sentiment that we're hearing from companies themselves, CEO optimism, which is elevated, a lot of investments. I think there's a lot of good reasons to stick with equities for now. So that's exactly the way that we've been positioned this year, and we don't want to change that as we head towards the end of the year. Relative preference of US over Europe, definitely, but I would like to echo some of Dan's comments before. Tariffs is definitely an overhang, from a high-level perspective, and 50% of revenues from listed companies in Europe are international. But essentially, you can't just look at it on a simplistic level because a lot of companies in Europe have local asset exposure in the US, producing and selling to the US rather than exporting, for example, out of a German warehouse. So again, the impact from tariffs is a little bit more complicated and less straightforward than what you would think from a top-down level. But certainly from a cross-regional perspective, clear preference for US over Europe. China is a neutral right now. We're still not convinced. Confidence has been low, difficult to reassert. The good news is that authorities are definitely much more mindful of the situation. They've made some big announcements up until now. The market just needs even more. You really need that big bang stimulus and more clarity in terms of what you're going to do. So it's a market that we're watching. It could surprise to the upside next year despite the threat of tariffs, but we're definitely not prepared to make that move, as Giovanni said right now. We'd rather look at other markets, maybe a little bit more insulated from the tariff threat. India, which is much more domestic, for instance, we're still positioned for upside in India. It hasn't done as well, clearly recently, given that bounce that we saw in China. Part of the flows came from India. But I do think it's a good macro story, earnings growth, and a little bit more insulated from some of the external risks going forward.
So let's take up that point, USA over Europe. I have to disclose that's also my position right now. But now a question to those three people here. I mean, the US is trading on, I think, 23 times earnings. I think Europe around like maybe 13, 14 times earnings. We have all burned our fingers, always making the call Europe over US. Is 2025 potentially the year for Europe? Who wants to take that question?
Then I guess so.
Thank you for volunteering me, Anya.
I have another one for you, Anya, a little bit later.
So Thomas, I think you know better than any of us that valuations are never a trigger to buy, because unless you're like 2 standard deviations away, it really shouldn't be the reason why you're buying. I mean, multiples like PE, are very often just a wrong measuring stick because, the E's wrong. And so I think that's what the market's telling us right now on US equities, is that the E's wrong. And they told us that before the election because the markets were pricing in a Trump victory, i.e. an extension of the tax cuts, and possibly with a red sweep, which is what we got, even lowering the corporate tax rate. So not just an extension of the 30 to 21, but 21 to maybe 15. And then that would allow multiples to expand, and all of a sudden, earnings go up, and the US doesn't look so expensive. And what you saw immediately in the reaction to the election result was that the Russell did very well. So small caps, domestically exposed, did well. So the expectation that the stimulus for the domestic economy would accelerate U.S. growth. And I think all of the policies that we now know, the ones that we know so far are going to be implemented, are essentially strong dollar short term. So that's going to suck some capital back into the U.S. and with the rates differential such that U.S. So our expectations are that the U.S. is growing at least 2% next year. That means that you have better growth, higher rates. Of course, that's very dollar positive and dollar asset positive. And I've now forgotten, what was the question? Oh, Europe. Sorry, I'm not avoiding the question. And so when I look at Europe, not to just repeat what George was saying, we look at the DAX 30 or we look at European multinationals and we think, well, tariffs are a complex thing to tackle, but all of these policies basically, just like in the 1980s with the Plaza Accords, they incentivize foreign companies to produce in the US. And you remember back then, it was basically the US sitting Japan down at the table and saying, this is really great how well you're doing, Japan. Thanks, it's amazing. But you've gone too far now. You've now even bought our most prestigious golf course. And when the Japanese own Pebble Beach, that's the red line. And so therefore, we're going to devalue the dollar and we're going to force you to produce in the US. And I think Trump sees himself as that kind of a 19th century strong man that wants to sit down at a table and make a negotiation. And he's probably just going to try and force foreign companies to produce in the US. So I think foreign companies that do have assets in the US and that are producing in the US, many of the DAX 30, are going to do perfectly fine. So take opportunities in low valuations of these international companies.
Go ahead, Anya.
I will just take a little detour to what is more or less a similar argument, but I look for, to it from a more boring portfolio construction point of view. Yes, we also prefer equities over bonds for next year, which in our terms, however, means more moderate returns for bonds, so more neutral stance, but an underweight on the bond side. Still the same hierarchy, more equities than bonds, but for different reason. And we have a preference for emerging markets, by the way, not because we have fallen terribly in love with China, but we still continue to like India and Taiwan, and both of them are more dominant in the index these days than China actually is now, or to the same degree than China used to be. So if you have a neutral global equity portfolio and you have an overweight on the emerging market side, and you don't want to be underweight the US for all the reasons we have heard, then yes, there is a resulting underweight on the European side, just as a result of how you construct portfolios. And for us to change this, that would certainly need somehow a trigger. I agree, valuations, at least if they are not at extremes, and in my view, they are not at extremes, neither on the US side nor on the European side. You need really what we would call a catalyst, and that's something which I currently cannot see. Well, it can happen quite quickly. I mean, as soon as the dollar behaves in a decent way, that's all good. But we have also seen that currency moves can trigger some other assets movements as well. But for now, yes, we would keep that preference. Also, or having said this, the hurdle to overcome for US equities, especially, you know, for the Magnificent Seven, is quite a high one, especially when you look at what is expected in terms also of margins there. So we would generally call for some more moderate returns, still preference US over Europe, but with a clear focus on emerging markets.
Yeah, let's look what NVIDIA shows us tomorrow night. Maybe we give some guidance there already. So Giovanni, now you get that other special question is that, I mean, we heard about the US dollar, but when you are a balanced Swiss franc investor, I mean, one leg, I mean, when I look at the Swiss yield curve, I mean, the government curve, I think it's still not really above 1%. I think the 10 years around 40 bips. What should we explain to the audience here that are probably thinking in Swiss terms? Is there a solution? Is there something that they can diversify their equity exposure?
You know, I think for a Swiss franc investors, it's pretty challenging on the fixed income side. So if you don't want to have the currency risk, if you hedge that back, it's not going to be interesting to even go for the US dollar. So from that point of view, you really need to be willing to take a bit of risk. We just heard, and actually I agree on that, is that credit spreads are so low that you cannot take very much risk there. So in my opinion, actually, as a Swiss investor, you have two ways to do that. You have your equity exposure, where you have some exposure to Swiss equities. And the reason for that is because most of Swiss equities are international companies. And usually they do the hedging for you. So they will hedge their revenues in US dollar, in Japanese yen. Therefore, the Swiss market is going to give you a nice local return in Swiss franc. And then you add the global exposure. And in that sense there, I would go, unfortunately, for the time being, for the higher valued US equities and Japan. In Europe, you asked to be long or short Europe against the rest of the world. I think it's too early to burn our fingers. Usually Europe has to go to the brink of falling off the cliff to do political change. And I think that's what we have to wait for. We can look at valuation and say it's cheap relative to the rest of the world. And maybe you have a quarter where we're going to play out. But longer term, we really need substantial change in Europe. And to have the DAX exposure, now the biggest export of Germany are to the US, not anymore China, actually. Mm-hmm. So it's going to be interesting how this plays out. I agree more on the sense that, yes, there are tariffs, but that's just a way to get to the table and to do a deal. That's the Trump way to do that. And talking about inflation, we already had a period of Trump. And I think, maybe I'm wrong, but that we didn't see a lot of inflation through that.
Absolutely.
So in that sense, we are all fearing these tariffs. Yeah. But I think maybe it's a bit media-driven. So take a step back.
But maybe it's a different Trump this time, or
let's see. Yeah, that's exactly the point.
If I can add just two things for the
just go ahead.
For the poor Swiss franc bond investors, just as an idea. I'm not sure whether you've seen the heavily oversubscribed 81 bond of Deutsche Bank just this week. CoCos, in my view, and our view, is certainly something to look at from a risk enhancing point of view. And the other aspect is if you don't want or don't need to take so much risk, well, with Swiss govies at 0.4, it doesn't need much of a yield increase to wipe just out everything. However, as a potential alternative, look at Swiss money markets. It's something like 0.5, 0.6 is certainly still in the range, and looks for me better than outright government position.
I already got the sign to speed it up a little bit. I have two more questions. Question number one: what's the risk that we should look at, and not the unknown, because we can't make an investment strategy, but maybe risks that we know, but the market is not looking at it right now? Anja.
Thanks.
Sorry,
Thanks for
ladies
this one.
first.
Well, what I love is the dichotomy between risk and what I'm now going to say, which is that the biggest risk is really that we are all far too bearish here. There is a risk of overheating in our scenario. I guess the main scenario, like moderation stuff, kind of 55%, and the overheating bubble-like scenario can easily amount to something like 30%. So the risk that things go better to the degree that we really reach bubble-like territory on the valuation, that would rather extend us to 50 and 60, from the current kind of 30-ish territory. This for me is the risk, and therefore, you should not be too bearishly positioned.
Then
I'd say Anya's risk is my base case. I think that we are in overheating. I think that is the objective of most governments around the world right now. I think the playbook is 1990s. The big difference to the 1990s is that there's no leverage on corporate balance sheets. So corporates are actually very healthy, and all the bad stuff right now is not on the corporate balance sheets, is on central bank balance sheets. And so that can take us a lot further on risk assets before things go pear-shaped. And that's why I think spreads are so narrow, because the market's basically saying, who would you rather lend money to, Coca-Cola or the US government? Yeah, I mean, honestly, from a credit metrics perspective, corporates are just much healthier than governments. So this idea that governments represent the risk-free rate maybe is being challenged. And there have been instances in the past, like in the pigs crisis, where corps traded inside the curve. We had Italian government debt trading inside the curve because there was a government crisis. So I think the risk for us is a government debt crisis going forward.
Giovanni, a short answer from your side.
I also see the debt on the government side as the risk, but the biggest risk for me is that we are all on the same view. So if we are wrong, and not wrong on the positive side, but on the correction side, and everybody wants to get out from the same door, be careful. So in that sense, I would rather have a moderate exposure to risky assets, a bit of bonds to hedge, even though I don't trust the US. But finally, if you want to hedge, it's going to be, every institution is going to buy the 10-year future. So therefore, that's going to help your portfolio.
George, what's your risk number one?
I guess the first risk on my side is, some of the potential policy disruptions that could occur next year. So if we take at face value what has been pledged during the campaigns, universal tariffs, 60% from China, that is an inflation shock. That is a shift in terms of what the Fed would do. Not preparing for cuts, but potentially even contemplating hikes. At some point in 2025, if you go along those directions, I agree that there's not that much debt on the household side compared to history and on the corporate side, but certainly valuations on the equity side would certainly get challenged if the 10-year were to start rising closer to 5%, compared to current levels. I would say that is something that could change the narrative, but there's also upside risks, definitely. If China were to come quite forcefully, I think a lot of people have been burnt or sitting on the sidelines. So a little bit of a combination of both, but probably the tariff and the rate side would probably, worry me a little bit more if it were to play out on that side.
Okay, so thank you. So final questions. Actually, I shouldn't ask you that, but I have to. You can say, I'm not allowed to say anything. What about crypto? It has to come. I mean, everybody's talking about it, and with what BlackRock did, it's half legalized already. Is that something that goes through your mind? I'm pretty sure that all of you have already gotten some questions from RMs or internally, like, muss ich jetzt da auch noch dabei sein, like something like that.
By the way, just for the audience, Thomas Wille is a huge crypto fan, and so it's not surprising to us that he's asking this question.
But it's okay.
Well, in our asset allocation matrix, luckily we've got a strong double overweight Doge. No, just kidding. I think as allocators, it's come from the margin in and increasingly is becoming part of our allocations. I don't think it's in many allocators' standard portfolios just yet, or model portfolios just yet, just because from a multi-asset perspective, and Anya, you can disagree with me, but I don't think you will. When we look at crypto, we think, okay, from a risk budgeting perspective, what does it offer us? And in the end, it's just an alternative currency. And so if I'm looking at alternative currencies, I'd rather use gold with 1,000 years of data that I can see how it reacts under certain circumstances than crypto, where I only have a few years. However, yeah, clients are asking for it. And when they do ask for it, then we can put it in portfolios, because we had that sea change that you just alluded to when the SEC approved the BlackRock ETF on crypto. Because that now means I have a liquid instrument that I can apply over my 20,000 portfolios and trade easily. Before I didn't. Before it was very complicated, long trading times, and it was just messy. And now it's a possibility. So I think it will increasingly become part of asset allocation matrices.
You agree, disagree?
Both, I would say, yes, this way. What I like with regard to this discussion is that we have moved away from a very polarized view. So you either like it or you hate it. You really try to make sense of what it actually does for your portfolio. And from an, again, portfolio construction point of view, if you have 100% or 99% equity portfolio, you could add crypto, but you could likewise also add dried fish as, previous currencies, a couple of 1,000 years ago. It would also diversify your portfolio. So yes, it could make sense. In my view, we are, I would say, seeing more and more institutionalization of the asset class, given the ETFs in the US. And this is, by the way, one of the biggest risks for me. If you start to deregularize, most of the institutional investors will shy away from that asset class. Some other people might like it for the very same reason, but the institutional broad money base maybe will react a bit more cautious. And when you look at, the argument gold versus Bitcoin, you could, independent of whether I like it, we like it, but you could make the case that, well, in terms of increased geopolitical risk, it is difficult to run away, with 1, 2, 3, 4, 5 kilos of gold. It is definitely easier to carry a Bitcoin with you.
Giovanni. I don't fully agree, actually. I'm a very boring investor. So if I cannot value something, I stay away. I might lose the money there, but I don't invest. And actually, if they switch off the energy, you also cannot carry it with you. So for me, I would rather than, if you think about adding something to your portfolio, I would really go for private companies. There you still have the opportunity to participate in very, very young and growing stuff. So we really, at the moment for us, and I get that question a lot also in the company, we shy away from crypto at the moment. Obviously, we can be proven wrong, but I think it's really, we need to find out how to value this asset, and once you understand that, then it's the right step. That's my view. I mean, and that's how we implement that.
George, are you in between, or what's your view on that?
Yeah, Thomas. Well, officially, we don't have a view, but you're pushing us to the wall here. So, if I do have to comment, clearly, some of the near-term drivers, as Dan mentioned before, the SEC approval clearly was a game changer this year. I guess the fact that it's clearly positioned within that Trump trade, given the scope of regulation, right? That was always a big question mark. If you do expect a US administration that would be more in favor of looser regulation, deregulating, and so on, that could suggest less of an imminent threat as well. So I think momentum is certainly supportive for the trade in the near term. I echo Giovanni's point in the sense that we're not really comfortable to value Bitcoin going forward, which is also why we don't recommend it to our clients. But we have done some theoretical work in the past, a little over a year ago, 2 years, where basically, we tried to study the behavior of Bitcoin, mapping it with other factors and other asset classes. And we came to the conclusion that if we were to have it in our strategic asset allocation, it would probably be to the tune of 2 to 3%, just to give a little bit of a handle, to the audience in terms of what kind of allocation we would contemplate. But, as it stands, we have no allocation.
Thank you very much. So we are at the end. Before I open for 1 or 2 questions, a big applause to the 4 panelists. Any questions from the front, in the middle, or in the back? So it looks like that. Yep.
It is certainly one, but of course, we try to cover that already with a more strategic view and a strategic asset allocation. We don't think you can time your protection with regard to the geopolitical risks. So having, of course, some, I would say, some gold and also commodities as part of the portfolio will help. The very fact that we actually look at the portfolios in Swiss franc is already helpful compared to any other maybe currency in that case. So yes, that's kind of. I fear this is part of the base scenario these days, that you will have in an environment with increasing, well, I guess we have called it, a couple of years ago, multipolar world. But at that point in time, multipolar world was something positive, I guess. And these days, those poles are not so friendly anymore. I guess this is part of the reality, and we, as I've mentioned, factor that in on the strategic side.
Can I just follow up on what Anya was saying? So very clearly, if you want to be hedged against geopolitical risk, you do exactly what Anya just said. You need to have safe haven assets, but you wouldn't want to be fully allocated to safe haven assets all the time, because you're going to miss out on the market upside being allocated only to those safe haven assets. But the commodities part, I think, is very poignant. And I think commodities you see increasingly being part of the asset allocation matrix of ours, just because as the US weaponizes the dollar against its adversaries like it did against Russia, why wouldn't the rest of the world, the BRICS, start weaponizing what they have to weaponize against the West? And commodities are very often the way they can do this. Why would Russia not potentially weaponize nickel? Because most of it comes from Norilsk. And it's going to put the rest of the Western world in a difficult situation if it restricts the supply. And the whole topic of energy transition, but also the energy intensity of AI is very commodity intense. So a good way to give yourself a diversification between these two, the West and the rest, is to increase commodity in allocation as part of a diversified portfolio.
I have the question. Thank you very much for this. Given that a lot of the earnings growth in the US was driven by the Max 6 or 7, are you recommending your clients to be overweight next year in the Max 6 or underweight, or you simply take what you get with passive? Thank you.
Well, the way you could implement it, but also, it's a very straightforward, and, you could definitely do it in a much smarter way. If you believe that there's a bit more of, I would say, mean reversion in all of that, then any kind of equal weights, would do good. There are smarter ways in, just kind of underweighting that a bit. We would see more moderate returns and more, coming back of the other areas of the economy.
Maybe I can add on that. I think, the exposure to the Max 7 you will have, but what we are looking for are now the second round effects. So there are going to be companies who are going to have economies of scale by implementing AI. And I mean, we are all experimenting with AI, I think, here, but it's not yet implemented. And therefore, you're going to find really there the most added value. And the other leg is the energy intensity of this process. So therefore, you can try to build a portfolio with that in mind, still having exposure to AI, but not just in these Magnificent 7.
So that's the value chain argument, or that it kind of eats through different kind of sectors now.
Okay, all the other questions, please, when we have the upper a little bit later, I want to thank once again, George, I think you were in Geneva. Thank you very much. And also Anya, Dan, and also Giovanni, thank you.
And thanks to you, Tom. And now is a 10-minute break. So like we have to shorten it a bit. So 19:15, we have to be back. Sorry. Yeah. Okay.
Moment, du, sagen wir mal so ist das. Arbeite mit einem zusammen, der die Hälfte von seinem Vermögen.
My phone number. My card, exactly. Yeah. So now if you scroll down, you do create new contacts, and then you do just that. Okay.
Actually, I don't know. Oh, okay, good. Is there anyone who knows?
Ich komme gleich zu Ihnen.
Aber das Mikrofon mit dem.
Ja, genau.
Ist es frei oder ist es besser?
Nee, das bekommen Sie gleich von mir.
Ah,
Genau.
okay, also jetzt, okay.
Ja, ja. Perfekt.
Yeah, right. Wollt ihr die jetzt doch noch haben? Kamera. Also, wir brauchen schon eine Kamera. Für die online. Ach so, weil du wolltest doch gerade, dass ich das zumache, oder? Ah, nein, nein. Also nur für den Speaker, aber nicht. Wo kommt der denn? Der Speaker? Also die Speaker braucht es nicht, aber die Leute sind. Wir streamen es. Ja, aber wo? Ich weiß, dass sie es vorhin gestreamt hat, genau. Das ist wahrscheinlich Zoom. Ja, Zoom. Oder da ist Screenshare ist immer noch dran. Ja, ist immer noch an. Hier, oder? Hier? Ah ja, perfekt. Okay, dann gehe ich wieder rein. Sorry. Nee, ja, jetzt mache ich alles wieder wie vorher. Ich kann ja alles ausrichten, klar. Nee, die muss schon hier in der Ecke bleiben, aber ich kann ja alles ausrichten. Wie bitte? Nee, leider ist der Markt verhindert. Nee, der ist leider verhindert. Ich habe ihn gesehen, aber ist weg. Er ist weg, ja, ich habe ihn nicht gesehen. Ah, scheiße. Ich krieg schon hier irgendwie. Ist okay, worst case habe ich schon. Einen Moment. Ich kümmere mich drum. Ich habe es gleich im Griff. Ich packe sie jetzt hier gleich auf den Tisch. Das ist hier ein bisschen höher. Das Problem ist dann, der Winkel ist nicht gut. Okay. Was ist denn die Herausforderung genau?